What's interesting right now is the views on India's strategy, and there's a whole host of notes talking about what the India strategy should be. Harsh has put it all together, and I think the overwhelming message, Harsh, is that the growth path remains intact.
Absolutely. That seems to be the underlying and that seems to be the consensus as well. Let's first pull up what Macquarie is sensing with regard to this one. They're saying, of course, this is a tough pill to swallow. There's very little place to run or hide. They are therefore swapping 3 global-facing names in their India portfolio with something which is relatively more insulated on the domestic front. I'm going to start off with a Bharti Airtel. These are reasons why they believe and why they are positive with regard to Bharti Airtel. ROIC visibility to go towards that 20%, currently at 10% by FY28. Ultratech Cement is the other one. Within the cement pack, they believe price hikes is the key trigger along with secular demand growth. And last off, they have GAIL, where they believe that a 10 to 30% hike in transmission tariffs by June could well be the trigger for a GAIL. Again, inward facing. What are they avoiding completely at this point? A Sun Pharma, where they believe volatility is high given the US exposure. They also believe that Tata Motors, there's increased uncertainty, and they're also saying Wipro is now out of their portfolio currently. So these are the deletions that have happened in their portfolio. Now, in terms of Motilal Oswal, if we're looking at, they believe that things are uncertain. There are many possibilities. Friendly actions on the policy front could help calm things down is what they are saying. India relatively less affected than peers, and company earnings in Q4 have largely, or rather will largely stay the same. India's policymakers have taken steps to boost the economy in Q4. These steps and stronger basics give hope is what they're saying. And over time, India looks good because of its own strength. That's what they're saying. What are they liking? They're overweight BFSI, IT, industrials, healthcare and telecom. They're underweight on oil and gas, cement, automobiles, real estate and metals. That's what they're not liking. Their model portfolio, they're liking HDFC Bank, Kotak Bank within financials, TCS, Tech Mahindra within IT, Titan, Trent, Indian Hotels, Page, HUL within consumer. They're liking L&T, ABB, Dixon Tech and Keynes Tech within the IT, within the tech space, and Dr. Agarwal's healthcare within the healthcare space. So that's kind of rounding it off. Last off, Morgan Stanley, they believe that they expect Indian equities to be closer to bear case than bull case in 2025. Domestic growth could be on the mend given policy shifts. They're also saying that India's trade deal, and this is very, very important, more likely than not, may take time but will happen is what they are saying, more likely than not. They're expecting a favorable policy on the 9th of April. And in terms of flows, they believe retail participation is structural and not opportunistic. And FPI equity positioning is at its weakest ever since 2000, making a good case that India may just be well placed and not as badly placed as peer markets.
And this is a case that a lot of people are making based on the expectation that there will be an improvement in several metrics heading into the new financial year, which has already begun. I'm curious, Sunny, what you make of the play on cement, because a lot of people seem to be talking about this, the price increases that have already taken place bode well for the space going forward, and Q4 might actually already see an improvement in earnings. So what is your view there, and what would you be buying?
Yes, sir, definitely, Alex. I think if you look at September quarter and December quarter, those were the two very muted quarter as far as the entire cement industry is concerned. So even on EBITDA per ton basis, I think the cement industry right now is grappling with a kind of 2-year low EBITDA per ton metric. So I feel post the recent price hike coupled with a decent 6 to 7% kind of volume growth for an industry, I think all the players are likely to report close to 100 to 200 rupees bump up in EBITDA per ton for fourth quarter. And the same momentum is likely to continue in FY26. On the top of that, the recent correction in the coal prices again augurs well in terms of cost saving for all the cement players. So I think again trading at a reasonable valuation was a kind of underperforming sector since last 4 to 6 quarters. So again, our topic here would be JK Lakshmi Cement, which is under our coverage. So JK Lakshmi is our topic. On a regional play, we like a Star Cement, which is a northeast based player where we have seen recently Ultratech buying a 10% strategic stake in that company, so Star Cement. And among the frontline play, Ultratech, where we have seen because of the its own organic as well as inorganic capacity expansion. So that will become a kind of close to 25 to 30% of the industry market share in terms of capacity to Ultratech. And Ambuja, again a similar story playing out in Ambuja, where we are seeing an organic as well as inorganic growth in terms of capacity.